Hi everyone, my name's Evan Andreo. Now I've come to the shocking realization that I'm not as young as I used to be. And with each passing day, I get closer and closer to retirement. And that's got me thinking about what happens after I retire. How do I invest my money to support my income? And particularly, how long is that money going to last me? Got me thinking about longevity. Now, how long am I going to live if I retire at 65? Well, just to put it in perspective, if I was 65 in 1800, I would have been dead 27 years already. If I was 65 in 1900, I would have been dead for 12 years. In 2000, if I was 65, I'd probably still have 12 to 15 years to go. And there's studies that show that by the year 2100, which is not that far off, if I'm 65, I'm probably only halfway through my life. In fact, Time magazine had a front cover not so long ago where they were referring to a baby that could potentially be the first person to become 140 years old. My biggest fear is that my income isn't going to keep track with inflation. Inflation is going to be the killer. If I can't beat it, I'm going to lose purchasing power and just become poorer and poorer. Now, I'm a fairly conservative investor. I've been investing in relatively low risk portfolios, money market type of instruments for quite some time. And it's been pretty good, to be very honest with you. It's been pretty good. The only problem is, to my mind, if we look at what's happened with short-term interest rates in the last 12 months, I'm very concerned that I'm not going to be able to keep that investment strategy and beat inflation. I need help. I need to know if there's anything else or anywhere else that I can invest my money. So I'm going to ask Kim Rasu from Tailored Fund Portfolios and Old Mutual Wealth whether she's got any suggestions for me. Over to you, Kim.
Good afternoon, everyone. Thank you so much for your time. And today I'm just going to be asking a crucial question is why I think that your high-risk assets are better positioned for long-term growth for your clients. So if you look at the chart that I've got up here, this is basically showing you your cumulative returns over the last 5 years for a high equity balance fund compared to what you would have got from an income fund. And as you can see, the income funds would have given you about 8% over the last 5 years annualized compared to what a high equity fund gave you of about 5.7%. And if you just compare on the far right, the volatility, income funds have a significantly lower risk than what you experience in a balance fund. And that's no wonder most clients have been allocating the majority of their assets to income funds over the last 5 years. As Evan mentioned, though, if you look at what the Reserve Bank have done with interest rates in 2020, interest rates were basically cut by 3%, which is the lowest that it's been in the last 50 years. And that interest rate cut has a direct impact on your investment into an income fund. Basically, to give you an idea, if you invest into a money market fund tomorrow, you have quite a good idea what your return is going to be over the next 12 months. And at this stage, it's about 3.5%. So if you think about the fact that inflation is 3.2%, your clients' assets are basically not going to grow with inflation, especially if they are accumulating assets for retirement or if they are in a living annuity and they're having to draw income to sustain their lifestyle needs. However, with an equity fund, even though we can't guarantee what the returns are going to be, and the markets can be quite uncertain, the opportunity for upside is basically unlimited. Okay, so the next chart I just want to show you, and this is basically showing you what returns have been for each asset class that we use when we construct a typical multi-asset class portfolio. And that's just over the last 6 months to show you what the markets have done post the crash after COVID. So I'm looking at the period August to January just to give a reasonable expectation. And as you can see, most asset classes, or actually all asset classes, have outperformed cash over this period. And basically, that is the key reason why we believe in a multi-asset class approach, where we build portfolios with a balanced view, and we are able to capture the benefits of asset classes that are doing well. And we're also able to buy into asset classes that are cheap at the moment from a valuation perspective and capture that long-term benefit of the return. If you also look again on the far right-hand side at the standard deviation calculation, you'll see they've got quite varied risk profiles of each asset class. And by constructing a multi-asset class portfolio, you're able to capture that in the portfolio. And that is a key important point when you're building a portfolio, that you are able to control the client's risk, especially in a living annuity example where the client needs to obtain a reasonable amount of growth to sustain his lifestyle and beat inflation, but he also doesn't want extreme market volatility because he's obviously wanting to draw an income and sustain his capital over the long term. Okay, then as I mentioned in the previous slide, just to show you the impact of inflation and basically what could happen to a client not saving enough. So what I've done is I've taken an example of a client, one investing in a low risk strategy like an income or a cash fund, and one investing in a high risk strategy. And each of them have 5 million Rand for retirement, and they require an income of about 6%. So if you look at the client on the left, the orange bar here basically shows you how the client's income would be impacted should we have bad market conditions. And basically after year 15, he will start running out of money and he will need to significantly drop his income needs. And by year 30, he would basically have no income left for his growth. On the right-hand side, same scenario, in bad market conditions, this client would also run out of money. So it doesn't look, the picture doesn't look that good. But if you look at good market conditions, which is the purple line in both charts, you'll see the client on the left will basically be able to sustain his lifestyle a bit longer, but still run out of money eventually. And then the client in the high equity balance fund, however, he'll be able to sustain his income payments for the full 30 years or even longer. And basically what's important here is just to conclude, clients, basically, again, we cannot control market conditions and we don't know what the future holds. But what we do know with quite high certainty is in a low risk strategy and in a low interest rate environment that we face at the moment, a client will have significantly lower returns and possibly not be able to save for his retirement goals after inflation. So the next part of this webinar, Roland will just take you through how we actually go about the technical parts of constructing a high-risk portfolio that is suitable for long-term growth. Thank you so much.
So how do we build living annuity solutions for clients in this challenging low interest rate environment? Let's first look at clients that select a withdrawal rate of below 3%. Generally, it is quite easy to build an investment solution that can meet this objective quite consistently. The bulk of the assets are typically invested in local fixed income asset classes. So local fixed income, as well as inflation-linked bonds, are particularly useful in achieving real returns of around 2 or 3% consistently. Cash is also a useful tool to manage volatility. Offshore exposure is a good diversifier, but should be limited so that currency risk doesn't dominate the portfolio. For clients with a withdrawal rate of between 3 and 5%, it becomes a bit more challenging to build a consistent solution. You require considerably more exposure to growth assets, which means higher volatility. In this space, we believe offshore exposure is really useful to provide growth, but should generally be limited to no more than 40% of the overall solution. The addition of a smooth bonus fund could help a lot in smoothing out the volatility of performance, which can then make client conversations a bit easier. The last category of clients require withdrawal rates of about 5%. It is extremely challenging to build investment solutions that consistently achieve real returns of 6 or more. We would caution against investment solutions designed to achieve inflation plus 7, 8, or 9%. It's simply not realistic, and the concentrated portfolios typically built can be extremely unreliable. Also, avoid sector concentration, such as local listed property, preference shares, or adopting a strategy that target high dividend yielding stocks. So what is our ideal solution? What do we typically recommend? I'm going to look at the retirement income unconstrained portfolio as an example of a typical implementation for a client with a withdrawal rate up to 5%. So we have a few important components in this solution. 50% of the assets are allocated to the absolute smooth bonus fund. This should provide quite consistent returns and over the long term achieve real returns of around 5%. The rest of the assets are invested with a big emphasis on offshore exposure, so that the look-through exposure is around 40% offshore. We don't hold any cash because these are highly liquid, daily priced investments. Local fixed income is a useful tool to manage risk and to provide a high yield, especially given the current market environment, where 10-year bonds are trading at a very healthy yield. We hold no global bond exposure because of the low interest rate environment in global bonds. So let's pull all of this together. It is really challenging to provide living annuity solutions that consistently achieve the desired outcomes for clients. As you move from 3 to 4 to 5% real return target or withdrawal rate, you have to accept an increasing amount of market risk. Firstly, we think using a smooth bonus fund product as part of your solution is a useful tool in having better and more consistent client conversations. Be cautious about offshore exposure. It's good to have some global equity in your portfolios, but above 40%, currency risk starts to dominate the portfolio. Also, keep in mind, in the current low interest rate environment, reliance on income strategies as well as money market investments will not give you a successful outcome in living annuity implementation. If you look at past performance, it looked like it's a reasonable strategy, but going forward, this will simply not give sufficient returns to your clients. And lastly, have the right conversations with your clients up front. Warn them about what to expect and ensure that you take an appropriate amount of investment risk to sustain the returns required by your client.